This material breaks down the August 2026 Bitcoin rally to $73,000, analyzing the macroeconomic, regulatory, and technical catalysts behind the surge. The piece is highly rigorous, clinical, and successfully avoids typical crypto FOMO. Because the baseline analysis is already so strong, this critique skips the basics and dives straight into high-level architectural and thematic enhancements to maximize the editorial impact.
So, a key theme running through this material seems to be the rapid succession of isolated events driving this price action?
Yeah, absolutely, because when you look at it, the text currently lays out like 5 specific catalysts right there in the main body, just sequentially.
Right, it's just a list. You've got the Treasury liquidity injections, then the massive short squeezes, Trump and the SEC's regulatory maneuvers. Yeah. And then it goes right into whale accumulation patterns, and finally, the technical chart structures.
Right.
Which, I mean, it's an incredibly comprehensive collection of data, but grouping the 5 isolated catalysts into distinct overarching categories will elevate the analytical rigor of the piece and clarify the market mechanics at play.
Okay, yeah, I can see that.
Because the weakness here is that the text presents all these really complex drivers as just a flat list, numbered 1 through 5.
Right, which kind of flattens everything out.
Exactly. It inadvertently dilutes the author's own stated goal from the intro. You know, they wanted to differentiate between long-term structural drivers and short-term speculative noise.
Oh, I see. Because when a reader sees a list numbered 1 to 5, human psychology just, it immediately assumes a progression of equal parts.
Yes. And a technical chart pattern it's not operating in the same dimension as the U.S. government adding to a $40 trillion national debt, right?
No, not at all. So how do they fix that?
Well, my suggestion is to reorganize this desarrollo section into 2 distinct pillars. So, fundamental drivers and mechanical accelerators. This creates a clear hierarchy of information.
Oh, I like that terminology, fundamental drivers and mechanical accelerators.
Yeah, it really separates the types of momentum. So for concrete examples, under fundamental drivers, the text should combine point 1.
That's Scott Bessent's $4 billion Treasury bond buybacks, right? And the $432 billion July deficit.
Right, exactly. Combine that with point 3, which covers Trump's Clarity Act push and the SEC exemptions. Those are fundamental shifts.
Yeah, they change the actual landscape.
Exactly. Then create a mechanical accelerator section that combines point 2, the $4.23 billion in short liquidations, and point 5.
Point 5 being the inverse head and shoulders pattern pointing to that $76,000 target.
You got it. And then for point 4, which covers whale accumulation, that can be positioned as a bridge. It shows how smart money plays the fundamentals while retail gets squeezed by the mechanics.
I can see what you're going for here. Let's see how we can strengthen this, but is there a risk that splitting them up thematically makes the chronological timeline confusing, since these events all happen simultaneously between August 18 and 21?
That makes sense. But could the evidence also support a different conclusion? Like thematic clarity being far more valuable to an investor than a strict diary of events?
Oh, I see. So it's about what the reader actually needs.
Right. Especially when we're dissecting intense market volatility, chronology is, it's often just coincidence. Causality is what actually matters here.
Yeah, that makes a lot of sense. Because they promised an analytical framework in the introduction, not just a recap of the week.
Exactly. To deliver on that promise, the architecture of the piece itself has to embody that framework. You have to physically force your reader to separate these concepts before they even process the specific data points.
Right. So you're saying that the Treasury announcing buybacks on August 19th and the SEC announcing exemptions on the exact same day, they're fundamentally the same type of fuel.
Exactly.
Even if they happen to come from different pumps, so to speak.
Yes, that's a great way to put it. By organizing them under fundamental drivers, the reader immediately understands that this is the heavy, slow-burning wood in the fireplace. It's not the lighter fluid.
Which the short squeeze definitely is.
Oh, 100%. When we look at Bessent's $4 billion buybacks, we're looking at actual liquidity mechanics. It physically pushes cash into the financial system, suppresses yields, and forces capital out further on the risk curve.
Right, to find returns. That's just a fundamental macroeconomic reality.
Exactly. And it works entirely differently than a short squeeze. So if I'm reading the mechanical accelerator section, I instantly grasp that these are forces of velocity.
Yeah, I mean, $4.23 billion in shorts getting liquidated in a single hour is violent.
It's incredibly violent, but it's an algorithmic, mechanical reaction. It burns really hot and really fast, but it doesn't change the foundational value of the asset.
Right, and that structural separation, I think, is exactly what makes the institutional whale accumulation data so much more impactful.
Oh, definitely. Right now, in the current draft, the whale data is just kind of sitting there at 0.4. It's somewhat orphaned.
Yeah, it feels a bit disconnected, but if you use it as that bridge between the two new pillars like you suggested, it tells a really cohesive story.
Right. You can literally write the transition to say, like, the institutional whales saw these fundamental drivers taking shape, and they accumulated $2.9 billion in positions, while the retail sentiment index was sitting at 46 in the fear zone.
Wow. Yeah, that paints a completely different picture. The retail traders were the ones trapped in the mechanical accelerators of the short squeeze, while the whales were just quietly trading the fundamentals.
Exactly. That reorganization instantly upgrades the piece from a solid recap to, well, a masterclass in market mechanics. It gives the reader X-ray vision into how different tiers of capital are behaving.
It really does. Now that we've separated the fundamental drivers from the mechanical ones, the writer does face a new problem. How do you keep the reader engaged through all this dense formatting and data?
Yeah, that's always the challenge with macro analysis.
The answer, I think, lies in the aesthetics of the piece, specifically a metaphor they introduced way back in paragraph 1.
Okay, so what I really like about this part is the narrative persona established right out of the gate.
Oh, the medical analogy. Yes, the author uses this highly clinical medical analogy. They compare the sudden Bitcoin price spike to a fever spike, or pico febril, and they label the U.S. Treasury's liquidity injection as the infectious focus.
It's such a strong opening. It cuts right through the usual financial hyperbole.
It really establishes immediate authority.
It does, and extending the initial medical metaphor throughout the entire text will create a highly memorable and cohesive narrative identity.
Right, because right now they just drop it.
Yeah, that's the weakness. The introduction establishes this brilliant clinical persona that perfectly aligns with the objective anti-FOMO goal they have. But this unique stylistic framing is entirely abandoned in the later sections.
Especially during the regulatory and technical breakdowns. It just becomes standard finance speak.
Exactly. My suggestion is to subtly weave clinical or medical terminology into the transition points and the final risk assessment to maintain this analytical persona from start to finish.
Okay, I like that. What would that look like in practice?
Well, for concrete examples, when discussing that mechanical short squeeze, the author could frame the massive $4.23 billion in liquidations not just as a trading event, but as an acute inflammatory response that exacerbated the initial fever.
Oh, wow. Acute inflammatory response. That's really good.
Right? And furthermore, in the concluding risk management section, instead of offering, standard, dry financial disclaimers about avoiding leverage, the text could phrase the warning as preventative care or prescribing a strict dosage of portfolio allocation.
Just to survive the market's severe volatility? I love that. It's like setting up a brilliant, moody cinematic lighting scheme for the opening scene of a movie and then turning on the fluorescent office lights for the rest of the film. We need to keep the mood lighting on.
That is exactly what it feels like. When a writer introduces a powerful metaphor like that, the reader subconsciously prepares to use that specific lens for the rest of the journey. When it vanishes, the text feels suddenly naked.
And a bit disjointed, honestly. Plus, the clinical metaphor is so uniquely suited to this specific asset class right now. Crypto analysis is famously plagued by overly emotional language.
Oh my gosh, yes. Everything is always skyrocketing or crashing or exploding. It's exhausting.
It really is. By adopting the persona of a detached diagnostician, the author immediately signals to the reader that they are about to get sober, actionable intelligence.
Yeah, it builds so much trust.
But if you're the writer, though, the hardest part of implementing this clinical metaphor is making sure it doesn't sound cheesy.
We want the mood lighting, but we don't want to turn the piece into a heavy-handed medical drama.
Right, you don't want to overdo it.
So how does the author implement this acute inflammatory response idea without making it sound like a gimmick? We don't want to lose the institutional credibility by leaning too hard into a creative writing exercise.
Well, it comes down to precision at the transition points. You do not need to rewrite the hard, objective data. The metrics surrounding the $8 billion in leveraged positions, well, they remain entirely factual.
Right. You don't mess with the numbers.
Exactly. You apply the metaphor only when you are explaining the market's reaction to that data. So when the 81 days of compressed price action suddenly violently uncoils, you introduce the terminology to explain the systemic shock.
Because a short squeeze is, by definition, the system attacking itself to find equilibrium.
Right. It's an autoimmune response.
Yes, that's exactly it.
The bears are forced to buy to cover their positions, which drives the price up, which in turn forces even more bears to buy. It's a compounding biological reaction. Using that language helps a non-trader deeply understand the sheer violence of a short squeeze, in a way that just saying liquidations doesn't.
It gives them a mental model to understand the market's behavior, and applying this directly to the conclusion is particularly strong. Financial disclaimers are usually incredibly dry.
Oh, they're the worst. This is not financial advice. Manage your risk. Readers just gloss right over them.
Totally. But if the author frames the ritos y consideraciones críticas section as a diagnostic chart or a preventative care routine, it reinforces the core thesis of the piece. Recommending against leverage isn't just a legal disclaimer anymore.
It's prescribing a strict dosage.
Exactly. It tells the reader, look, the market has a fever right now. Don't expose your portfolio to the contagion without protection.
It transforms a boilerplate warning into a thematic payoff. It rewards the reader for paying attention to the setup in the first paragraph.
Which is what separates functional writing from exceptional writing. It's the connective tissue that makes the entire analysis feel like a single unified thought, rather than just a collection of bullet points pasted together.
Absolutely.
All right, so if the architecture is built on these two pillars, and the aesthetics are tied together with this clinical tone, what about the actual argument being made? Let's look closely at the section discussing the concluding bullet points, specifically the one labeled ritos, or challenges.
Yeah, that part is really interesting. The text briefly flags this tension between a decentralized asset and its current reliance on Washington.
Right, and it's buried at the very end.
Exactly. Foregrounding the paradox of a decentralized asset relying on centralized government intervention will transform a standard market update into a profound piece of commentary.
It really would elevate the whole thing.
Because the weakness here is that the text currently relegates its most intellectually fascinating insight, that Bitcoin's current rally is fundamentally driven by the very centralized institutions it was created to bypass, to a single bullet point at the very conclusion of the document.
Right, we're talking about the U.S. Treasury, the SEC, the White House. It's all centralized power.
Exactly. My suggestion is to pull this paradox entirely out of the concluding bullet points and use it as the central analytical lens through which the Treasury and regulatory sections are evaluated, right from the start.
So how do they weave that in early on?
As concrete examples, in Section 1, when discussing the $40 trillion national debt and the Treasury buybacks, the author can explicitly highlight the stark irony that Bitcoin's digital gold narrative is currently being validated by the exact fiat mechanics it was designed to critique.
That's such a powerful point.
Right? And in Section 3, the author can question whether relying on Trump's public push for the Clarity Act introduces a new, dangerous systemic vulnerability, an over-dependence on Washington's political theater.
I completely agree that this is the most philosophically compelling part of the piece. But wait, could highlighting this paradox too early alienate readers who just want the hard trading data, like the $66,600 neckline of the inverse head and shoulders pattern?
That's fascinating. What are the potential limitations or counterarguments to that idea?
Well, I just think institutional traders might just close the tab if they think they're reading a political op-ed or a manifesto instead of a strict market breakdown. They just want the actionable levels.
I hear that concern, I really do, but think about who is actually reading this specific piece in 2026. If we assume that technical traders are allergic to macro philosophy, we are severely underestimating our audience. We have to remember the context of the current market cycle.
Right. The text explicitly notes the all-time high of over $126,000 back in October 2025.
Exactly. The audience reading this piece today is not experiencing the blind euphoria of a price discovery phase. They have lived through a massive 30% drawdown. They have watched the asset grind sideways in the $60,000 range for months on end.
Yeah, it's been a brutal chop.
A reader who is holding through that kind of punishing volatility isn't just looking for a chart pattern to confirm their bias. They are looking for conviction. They are absolutely hungry for sophisticated macro analysis that explains the deeper mechanics of the global liquidity cycle.
They need to know if the foundation is solid, not just what the paint looks like on the walls.
Perfectly said. And the irony of that foundation is the defining financial story of the decade. I mean, Satoshi Nakamoto mined the Genesis block in 2009 with a message permanently embedded about the chancellor on the brink of a second bailout for banks.
Right, it was an explicit, mathematically hard-coded rejection of fiat monetary expansion.
And now, in August 2026, Bitcoin is surging specifically because Scott Bessent is pumping $4 billion into long-term bonds to suppress yields, and because a sitting president is pushing legislation to legitimize the asset class within the very regulatory framework it was meant to escape.
It's an incredible contradiction. Bitcoin is winning by playing the exact game it was invented to destroy.
Yes, and by burying that massive insight in a bullet point at the very end, the author is leaving their absolute best weapon sitting in the armory. If you pull that to the front, every single piece of data you present subsequently takes on a completely different weight.
It changes the tone from a simple bullish market update to a highly critical, nuanced analysis. When you present the $432 billion July deficit, you aren't just saying money printer go brr. You are forcing the reader to reckon with the fact that Bitcoin's success is currently tethered to fiscal irresponsibility.
Exactly. It introduces a fragility to the narrative. And if you're the writer, this is how you build trust with your audience. You aren't just cheerleading the price action. You are pointing out the cracks in foundation while it's being poured.
Which ties directly into the regulatory section. And this is where we really need to explain the mechanics of how these events drive the price. If the market is moving this aggressively because Trump mentioned hyperliquid at a White House meeting, or because a procedural vote on the Clarity Act is scheduled for September, then Bitcoin isn't actually decentralized right now.
No, it's not.
It is deeply, fundamentally centralized around Capitol Hill. We need to explain why that matters. When Trump mentions hyperliquid, it isn't just political theater. It instantly signals to institutional compliance officers that the regulatory ice is thawing, which mechanically unlocks sideline capital. That's the real mechanism.
Yes, and that is the exact kind of systemic risk the author promised to discuss in their opening objectives. By using the paradox as the lens, the author fulfills their promise to the reader instantly.
Because if the Clarity Act gets delayed again, or if the SEC rolls back those exemptions, the foundational pillar of this specific rally just collapses.
Right. Highlighting this paradox makes the piece top-tier financial commentary because it forces the reader to confront the reality that depending on Washington for a price pump is inherently dangerous for a decentralized protocol.
You're asking the reader to hold two opposing ideas in their mind at the same time. The price is going up, which is good for their portfolio, but the reasons it's going up introduce a massive new systemic risk.
That is the absolute definition of analytical rigor. It elevates the author from a simple market reporter to a true market philosopher. And practically speaking, for the writer listening to this, implementing this doesn't require rewriting the entire piece.
No, it's really just about framing your existing data.
Exactly. When you open the section on the Treasury, you simply state the paradox clearly before delivering the numbers. You tell the reader, we are witnessing the ultimate irony, the decentralized asset being fueled by centralized debt. Then you give them the data about the deficit.
It primes them to view the numbers critically, which makes for a much more engaging read. This has been such a deep dive. Let's bring all of this together. We've taken a comprehensive look at how to refine this already strong piece of writing, focusing on the structural architecture, the aesthetic tone, and the underlying philosophy.
Yeah, starting with reorganizing those 5 flat points into a clear hierarchy.
Right. Separating the fundamental drivers, like the macro debt and regulatory shifts, from the mechanical accelerators, like the violent short squeezes, and using the institutional whale data as the narrative bridge between the two.
And then we focused on maintaining the brilliant clinical persona established in the introduction.
Yes, extending that medical metaphor of the fever spike through the transitions, viewing the short liquidations as an acute inflammatory response, and treating the final risk management warnings as preventative care to survive the volatility.
And finally, pulling the core ideological contradiction out of the concluding bullet points. Using the profound paradox of a decentralized asset relying on centralized government action as the primary analytical lens to evaluate all that Treasury and regulatory data.
These changes transform an already rigorous market breakdown into an unforgettable, high-level piece of financial commentary. We highly encourage the author to implement these structural and thematic changes, and we warmly invite you to submit your revised work or your next market analysis back to the critique for further review. Until then, keep an eye on the infectious focus and always prescribe a strict dosage for your portfolio.